Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the sunny Pacific Northwest, Thursday afternoon. I hope you guys are doing great, staying safe, staying healthy, staying sane. And thank you again for spending a little bit of time with me on this beautiful Thursday afternoon to talk about the real estate and mortgage industries. And boy, oh boy, there's just all sorts of stuff going on here. I'm going to jump right in, talk about something that we haven't talked about before, and I apologize for the shadows. It's interesting. We have sun, and so sun brings shadows. And I apologize. I don't have a really sophisticated setup here with the lights. So bear with me as I try to move this thing one way or the other, try to minimize some of that. But all right, let's just jump in here. Technical issues and shadows notwithstanding. And let me tell you what is happening in the mortgage industry here, because this is a turn of events that I'm really not all that thrilled about. It impacts me personally and directly, but it also impacts a bunch of other people as well. So what that is the FHFA, that is the agency that supervises Fannie Mae and Freddie Mac, has decided to make changes to the portfolio on second homes and investment homes. I'm going to do a little bit of a deep dive here to bring you guys up to speed, but the bottom line is that this agency has just made it that much more difficult for investors like myself and others, a lot of other people, to finance second home purchases and investment home purchases. They've made it, when I say more difficult, let's just be honest, they've made it more expensive. Those rates are going to go up, and those loan programs are going to be a little bit more difficult to finesse, and that is done by design. Now, why did they do that? Well, the messaging that they say is that they want to make it more easy, or easier, I guess would be the proper English term. They want to make it easier for individuals to buy a primary residence. And so rather than having all these folks who are looking for a primary home competing with investors or with people looking for a second home, they want to make it more expensive for people buying second homes and investment homes, so that it drives us out of that market and makes more inventory available to the to the people buying their primary home. That's kind of like their logic, or that's what they've explained in the press release. I am a little bit dubious about that, and I'll tell you, that may very well be, but I find that there's probably some other reason for that. And I, at the risk of sounding conspiratorial, I'm going to tell you that there is a huge hedge fund out there named BlackRock. You may have heard of them. And BlackRock has been buying gazillions of single-family homes on their own, using their own money, not financing it, not buying homes with mortgages or having those mortgages sold to Fannie Mae and Freddie Mac. They've been paying cash for it, and they continue to do that, as does Invitation Homes, which is a publicly traded company, and a variety of other really large concerns. And I got to tell you that my tinfoil hat, my conspiracy theory, please don't judge me too harshly, but I always think that, we should follow the money. I don't know if you guys know this about me, but I have a degree in journalism. I used to work as a newspaper reporter many years ago, face made for print, not for TV. And we had a saying in journalism, which was follow the money, right? Whatever's going on, someone's making money off of it. And that's really where we focus, or should focus, our attention. And BlackRock is making tons of money buying these single-family homes directly from the builders, paying cash for them, and then turning them into rental properties and renting them out at, really strong market rents. And that's good for them. I mean, I have no problem with that. I want to do the exact same thing. The difference is that BlackRock has enough money to make enough campaign contributions to have government officials use the levers of government to tilt the playing field in their favor. Are they doing that? I don't know. I can't say for sure one way or the other, but I would, if it was my money, if I was a trillionaire, and that's what BlackRock is, it's $1 trillion plus hedge fund, why wouldn't I use the levers of power and the levers of government to tilt the playing field in my favor and in favor of my investors? That's just what big companies have done forever and ever. And we can talk about the propriety of that. We could talk about whether or not that's fair, whether or not that's kosher, whatever you want to call it. But me personally, I think that that's one of the things that's going on. So how is BlackRock doing that or not doing that? What does this move by Fannie Mae and Freddie Mac and the government agency that oversees them, what does that look like to make it more difficult for investors to buy single family homes as second homes or investment homes? Well, it goes all the way back to the fact that when we do a mortgage, what ends up happening is that note, as I've mentioned time and again, that IOU gets sold to Fannie Mae and Freddie Mac. And Fannie and Freddie basically are what we refer to as a liquidity facility for us. So we loan money. My company does, every mortgage lender loans money to buyers. And then when we're done funding that loan, we take the note and we sell it to Fannie Mae or Freddie Mac, and they pay us for it, make us whole on that. We pay our lenders back, and the cycle continues. Well, what Fannie and Freddie are going to do now is increase the costs to my company and to companies like mine nationwide to sell notes to Fannie and Freddie for second homes and investment properties. And by increasing the costs to sell that paper to Fannie and Freddie, what ends up happening is that by default, we're either going to have to increase the interest rates on those loans, or we're going to have to charge the investor, the home buyer, points to make up the difference. And that's really how it works. So with one pen stroke, the management basically of Fannie and Freddie have decided that it's going to be more expensive for us, the individual investor, to borrow money to buy a second home or an investment property, and that's just the way it's going to be. And it's already started to get priced into the market. It's already started to get priced into the interest rates because this is how it works. I mean, it rolls downhill. If Fannie and Freddie say we're going to start charging more, then we're going to have to start charging more to our clients as well. And like I said, I'm of the opinion that this is motivated to a certain degree by these large publicly traded companies and hedge funds that would like to squeeze the small investor out of the market more and more. And they don't need Fannie and Freddie because they pay cash. So if you're a cash buyer, you don't need a mortgage. Interest rates are irrelevant to you. So this is kind of one of the things that's going on. Why this is particularly upsetting to me personally is because I have a plan to buy investment homes. And I also have been telling my clients and anyone who will listen to me on Facebook that buying a home, buying a second home, buying an investment home, buying a primary home, whatever it is a great hedge against inflation, which is true. But now they're making it more difficult to do that. And so it's a little bit, the timing is curious. It's a little bit frustrating to be sure. And we're just going to have to deal with it. Change in leadership may change direction in what Fannie Mae and Freddie Mac does. So everything at the end of the day is political. The people that oversee Fannie Mae and Freddie Mac at the FHFA, they're appointees. It's a political appointment. Yes, of course, they know what they're doing, I would imagine, but they're appointed by political patrons. So change in leadership, maybe you get a change in management, and maybe they pull some of these policies back. But for now, this is what's going to happen. And that's unfortunate because right now, as the markets continue to turn, and if you're in the stock market at all, if you've got a 401k or an IRA or whatnot, volatility is just going bonkers right now in the markets. And the question is, why? And the answer is inflation. Inflation is what the Federal Reserve Board is supposed to be on top of. Their mandate is to keep the rate of inflation at 2% annually, meaning that the cost of things across the board goes up by 2% from one year to the next year. Well, right now we're at 7% and climbing. And so the Fed has dropped the ball on its number one mandate, and everybody knows it. It's not a secret. So the question is, what are they doing to fix it? And they've got relatively few tools in their toolbox. One of those tools is that they have stopped buying, or they're going to slow down their purchase of mortgage-backed securities. That's what Fannie Mae and Freddie Mac does with all of the loans that we sell to them. They turn them into mortgage-backed securities, and they sell them through Wall Street. to pension funds and 401ks and things of that nature. The Fed is among one of the most prolific buyers of these things. In fact, they've been buying, up until recently, $40 billion worth of these instruments every month, if not more. That's what they told us they were buying. They're not very transparent. I'm willing to wager dollars to donuts that they probably have been buying a whole lot more than that. But now they're slowing that down, if not stopping completely. And that has an impact on the market. That has an impact on the bond market, and by extension, that has an impact on the stock market. Keep in mind that these investment things, whether it's stocks, bonds, or whatever it is, money has to go somewhere. So if you're not performing well in one type of investment, then the smart money, the professional money, not necessarily me or you, but the hedge fund managers and the Goldman Sachs's of the world and whatnot, the Fidelities of the world, the Charles Schwab's of the world, those people, those professionals move that money around looking for better returns. And so the lack of predictability, the lack of visibility is making things very, very dicey and very volatile. And so one of the things that's happened is the markets have started selling off, then there's people buying the dips. There's a lot of emotion in here. But what the Fed has already said has already started doing is they're going to slow down their acquisition of universal mortgage-backed securities. And that's I guess that's going to be a good thing. We'll soon find out, because here's the deal. The Fed owns more than $4 trillion worth of mortgage-backed securities and U.S. Treasury notes. In fact, the Fed makes up about 30% of that entire market as far as owning this paper. So they're in it. I mean, they're deep investors in this thing. And what they do is definitely going to move the markets, and it's certainly going to impact the economy. But what they have to do is get their arms around inflation. And so the other thing that they're talking about doing is increasing the cost of short-term money. Right now, the Fed charges its member banks basically zero to loan them money for short term. And by extension, the banks charge their best clients 3.25% for loans. That's known as the prime rate. That's not your mortgage rate or anything like that. That's the prime rate of interest. Well, the Fed is about to tighten that, meaning that they're going to increase the rate, what they charge their member banks, and the member banks are going to pass those fees on to borrowers like you and me and everybody else. And the reason that the Fed wants to do this is because they literally want to pull money out of this economy. Cheap money needs to come out of this economy so that you and I and all the other companies and individuals don't have as much money, cheap money, borrowed money, to spend on goods and services. The idea behind that is that with fewer dollars chasing the same amount of goods and services, in order for those goods and services to be palatable, to be bought, the price has to come down. And there's the easing of inflationary pressure. That's what the Fed is going to try to do. And so the market has fully priced in that starting in March, the Fed is going to increase the short-term interest rates by at least 0.25%, 25 basis points, maybe as much as 50 basis points in one shot. And they may increase up to 1.25% in total for calendar year 2022. So the prime rate would go from 3.25 to 4.5 in this calendar year, if the Fed actually does that. And what that effect does is basically it pulls money out of the economy, hopefully brings down inflation, but there's an equal and opposite reaction to every action. And in the past, when the Fed has done this, they did it in the late 1990s, early 2000s. They did it in the late 1970s, really early 80s. Every time they've done it, the market, the stock market, has had a major sell-off because, and this is really important, because a lot of these really big investment houses have been borrowing cheap money, pumping it into the stock market, riding gains all the way up, making good money, good returns on their investments by borrowing and investing cheap money. That money ain't going to be cheap anymore. And so a lot of these companies are getting out. A lot of these investors are getting out of the cheap money that they've been borrowing. And as a result of that, there's not as much money out there to support the elevated prices on a lot of the stocks that are in our portfolios. And so what happens is the stock market starts to come down, which we've seen. In 1999, early 2000, when Alan Greenspan did the same thing, he was the Federal Reserve Board chairman at that time. Alan Greenspan said about the stock market that it's suffering from irrational exuberance. I remember this. This is right around the time I moved to the Seattle area for a job with a high-tech company that we had invested in. And guess what? When Greenspan started raising the interest rates, the stock market tanked, the internet bubble burst, right? And the S&P 500 lost 50% of its value in the span of like a year or two. That is a really jagged pill to swallow. Now, the good news is that the rate of inflation came way down as a result of what Greenspan had done. But the opposite reaction is that it caused the stock market to have a real meltdown. And in the past, more recent past, the Fed has tried to do some things similar to that to bring down the rate of inflation or to kind of curtail their involvement in the cheap money business. And the stock market has not liked it. And as I mentioned, these are political appointments, right? I mean, the Federal Reserve Board chairman, the chair people of the banks that make up the Federal Reserve Board, they are appointments. So they're appointed by political patrons, right? So everything is political. I'm not trying to make this political, but I'm just telling y'all the truth. These people were not appointed or hired just based on the merits of their skill set and their background. They are political appointees, and as a result of that, they've got to make sure that they're within the boundaries of the politicians that support them. So when the stock market melts down, if it does, and everybody has a conniption, the pressure starts mounting on the Fed to reverse course. What the Fed is trying to do right now is limit and tame the rate of inflation without tanking the stock market. That is a lot of chainsaws to juggle, guys. It's never been done properly. Let's put it this way. And all the time that the Fed has been doing this or trying to do this, there's never been a have your cake and eat it too. There's an action, there's a reaction. And we're going to see that. Time will tell. I'm not the smartest guy in this business, not even close to it. So maybe they can pull it off. Maybe they've got the magic formula. Maybe they can tweak here and twist there and make it happen. But time will tell. In the meantime, what we have is volatility. In the meantime, if you're watching your stocks, if you're watching cryptocurrency, if you're watching whatever it is, it's pretty unsettling to see things tank by 1,000 points in the Dow Jones in an afternoon and then rebound by 500 points later on that day. Like that's really hard for people to stomach. So we have to get this under control. The Fed has to do something with regard to its policy, its monetary policy. And ideally, the federal government's got to do something with its fiscal policy, but those guys are never going to do that. So let's not wish cast. But what's the impact on the mortgage market and on the real estate market? A couple of things. First of all, interest rates continue to go up, right? So as long as inflation is a problem, the long-term interest rates on a 30-year fixed rate mortgage will continue to go up until inflation is in check. Now, is that really high? No, right now it's not. We're at 3.75% or 3.625%, depending on your credit scores, the occupancy of the home, the down payment amount. But that does represent an increase of about 0.75% or 0.75% from this time last year to this time this year. So if you're thinking that you're going to have a low 3% interest rate or even 2.875, and now you find yourself in the mid to high threes, that could be a shock. And if you're really tight on your debt to income ratio, meaning that you don't have a lot of flexibility to take on more costs in the mortgage process, you might find yourself squeezed out of the opportunity to buy or finance a home at this time because the interest rates are making the payments too high. So the people at the lower end of the price points and who are really struggling and scraping to get into a home with a mortgage, they may find themselves in a little bit of a roadblock right now. Beyond that, the people who have a lot of their money and their net worth tied up in the stock market. I mean, I'm not one of these guys. I do have stocks, of course. I've got my retirement accounts, my 401ks, but I'm not there yet. I've got another 15 years. So I'm not really worried about it right now. But I've got a lot of clients who have, restricted stock units from Amazon or Google or Facebook or Microsoft or whatnot. And they're younger people. They've not experienced a cycle like this yet. I don't mean to minimize that, because it's not their fault that they just haven't been around long enough. But in the early 2000s, a lot of these people were 10 years old or 8 years old or 14 years old, and they just don't have the background. It doesn't mean that they weren't paying attention. Just, when you're 8 or 10 or 12 years old, are you really that involved in what's going on in the economy and in the stock market? No, probably not. But when you're 30, and you got a huge portfolio of Amazon stock because you work there, and you were planning on using part of that as your down payment to buy a home, and the stock is getting hammered because the entire market is going through these convulsions, how good do you feel about selling that stock and realizing what is currently a loss on paper? Paper loss means it's just numbers on a piece of paper until you sell the stock at a loss or at a diminished price. And then you actually realize that. How confident are these buyers going to be to part with their stock when the market's down? There's a lot of psychology that goes on here. So from the home buying perspective, this may actually put a little bit of a cooling effect on the white hot demand for housing. That doesn't mean that prices are going to go down. It doesn't mean that there's going to be another 2008 or 2009. Don't think that it's going to go in that direction. It just may be that for a while, instead of having 20 offers on a home, you might have 15 or 10 offers on a home, while the other buyers take a moment to kind of reassess and figure out if they really want to jump into this thing or not. That doesn't mean that the market's going to go away. It just means that right now, with all this tumult and all this uncertainty, people may take a pause. And it might also, with what I was saying earlier, with these rates and fees going up on the investors and on the second home buyers, there might be a little bit more inventory. There might be people who say, I don't want to pay 4.5. I just locked in an investment home today for somebody who's buying a property in Arizona, and their interest rate is 4.625. Not catastrophic by any stretch of the imagination, but if you're expecting it to start with a 3, and now all of a sudden it starts with a 4, that's going to possibly, if it's a business decision, it may lead somebody to say, maybe we don't need that investment home. Maybe we'd be better served in a different investment. So things are changing. Heaven knows we could use a little bit of a breather on the just incredible demand for real estate. I make a living doing this, so I certainly don't want to see the market tank, and I don't think it's going to, but it might be nice for buyers to not have to compete with 30 other buyers for the one home that's available for sale in the market. Remember, last month, as of December of 2021, sorry, I got a calendar in my head. In December of 2021, there were roughly 910,000 single-family homes available for sale nationwide, and there are probably 13 million households in the market for a home. So when I say it might slow down a little bit or it might push a few buyers out, it ain't going to push 13 million buyers out, and certainly it's not going to make it any easier to get more inventory on the ground. So we still have a massive imbalance. We still have a lot of buyers, not nearly enough inventory. So if you are interested, while the rates are still low, if you are interested to move your money out of the bank or out of the stock market and into a home, it's still a great time to do that. And I highly recommend that you speak with me or your mortgage professional, your real estate broker, and get pre-approved. Let's figure out what you can qualify for. Let's figure out how much buying power you really have, not just today, but next week and next month when the rates might be higher by 0.25% or more as the inflation continues to churn. It's going to be a while before inflation is under control. Keep in mind that our economy is massive. I use this kind of analogy. It's like one of those big cargo ships that you see offloading huge containers in like Long Beach Port or the Port of Los Angeles. Those things are not really maneuverable. They're not speedboats. They're not jet skis. You can't just zip them around. Same thing with the economy. It's huge. It's massive. If you put too much in one direction or another, if you turn the wheel too fast, too hard, you're going to tip the boat. And that's what the Fed is trying to avoid doing. It's a Herculean task, and I wish them well with it, but it's going to take time for them to just correct the course a little bit and see how things go, and then maybe correct a little bit more and see how things go. They can't just do it all overnight and hope for the best. So it's going to be bumpy for a while, but that's okay. We've been through this before. People were buying homes when interest rates were 18% in the late 1970s, early 1980s. We're not even near any of that stuff. So we got a long way to go. None of that bad stuff is going to hit that bad. But it's different, and nothing lasts forever, neither the good times nor the hard times. So we will keep on working. Let me check my time. Wow. Right on the nose. It is just about 30 minutes. So I'm going to take this opportunity to thank you guys for watching and for listening, and for my cousin over there, howdy. And I also want to encourage you to visit with me next week. I will be back, same time, same place. Until then, have a great weekend. Stay safe, stay healthy, stay sane, and thank you so much for spending a little bit of time with me. Have a great day. Bye-bye.